Moments ago, the Federal Reserve announcing its decision on interest rate hike.
The US Federal Reserve has again raised its key interest rate by 0.75 of a percentage point.
Federal Reserve raising by 25 basis points to a new range of 4.5 to 4.75.
Today, the FOMC raised our policy interest rate by a half percentage point.
So the Fed is raising interest rates, but what does that mean and how does it affect you and I? In today's video, I'm going to answer just that. But don't worry, just because I might look fancy, it doesn't mean that I'm going to come here and give a bunch of finance or economics terms. My goal today is to make it as simple as possible so you can understand. So give me a chance. For those of you who are unfamiliar, the Federal Reserve, or the Fed, is a central bank of the United States who is in charge of implementing monetary policy, usually through interest rates. The main goal of moving interest rates is to affect the economy, and in this case, it's done to fight inflation. So, how does it affect you? When the Federal Reserve raises interest rates, they simply make borrowing money more expensive. They raise something called the Fed funds rate, which is the interest rate that banks charge each other for loans. If the product that banks sell, which is money, becomes more expensive for banks, it is therefore going to become more expensive for consumers like you and I. That translates to the first point, which is that when interest rates go up, it becomes more expensive to take out a loan. That being a mortgage, a student loan, a car loan, or even a credit card loan. This makes it more difficult to buy those big ticket items like a car or a house. Now, for the second point, it's more on the positive side, which is that higher interest rates also affects savings. When interest rates go up, it becomes more attractive for people to save their money, and that is because banks start paying a higher rate on the deposits that you leave in your account. And third, higher interest rates doesn't only affect the borrowing for you and I, it also affects the borrowing for companies. When it becomes more expensive for a company to go and take out a loan, they can expand less, which will at the end affect the increase in their revenue and also lead to a stock market decline. So, how would it affect you? Well, if you're fresh out of college or recently been working like myself, it's probably just gonna affect you in the amount of money that you're gonna earn and the savings that you have in the bank. If you're in your late 20s or early 30s and you were thinking about making a big purchase, it's gonna become more expensive for you to borrow the money for that big purchase, so you might even delay it into another time. And as a whole, like I mentioned, higher interest rates lead to a slowdown in the economy, which can become too deep of a slowdown and lead to a recession. However, as we've seen with the recent increase in the stock market since the year started, it doesn't necessarily mean that we're going into a recession, but no one knows. So what do you think? Are we going into a recession or are we gonna avoid it? Leave it in the comments and I'll check it out. See you next time.